On this episode of Flux News Show, we're going to be talking how the physical spot crude market is on fire, how the tariff news is getting ignored, and we're in a big bull run. We've got a new section called the Hedge Fund Watch, and we're looking at how hedge funds are really struggling in this market and on the wrong side. Even the algorithms aren't doing so well. As always, please like and subscribe. Please interact as much as you can, give us the feedback. And remember, Onyx Markets, you can do all the trades on what we're discussing and all the contracts. Please check it out and hope you enjoy. We're going to do the sections as always, starting with the temperature check. Okay, so lukewarm. Bit harsh given how hot we've been and all that, just call it lukewarm, but it's just died down, right? The outright price is not as volatile. Had a bit of a break with Easter, right?
Yeah, it was a long weekend, but there's still been some moves. So since Tuesday when we did the last show, we're up almost $4 as of right now on Brent.
Yeah, fair. And I guess a bit of headline fatigue though, right? People not quite as sensitive, right, Harinder?
That's exactly right, yeah. So kind of the initial response to the China tariffs, the reciprocal tariffs from Trump and then China, all that has sort of kind of worn away a little bit. And even though Trump is coming out with some suggestions that he may roll back tariffs, the market right now is far more concerned about maybe the effects of the U.S. Iran conversations as opposed to so much about tariffs. So exactly, a lot of headline fatigue at the moment.
Cheer up. So yeah, I think in general, like we have to say that it's still a bull market though, right? I think that's what's caught most people by surprise. I would say the week before,
it was
like, oh, is it a dead cat bounce? Are we just in a volatile market? But all the signals were an underlying bull market, like we said last week. Great refinery margins, very strong crude spreads, basically everything rallying. So now the flat price is kind of on that north trajectory even more, with a slight respite after the Iran headline, like you were just saying. But I would say still the bull market. So I guess now we need to talk about what is driving the market, who is driving the market, what kind of thing is driving the market, and that is our herd mentality. What did you think it is?
Yeah, so I think the point that we mentioned about U.S. Iran, like there's a lot of interest behind that. There's a few different factors are at play. I think one that's kind of not so well known is that we're approaching sort of the 10-year anniversary of the initial 2015 U.S. Iran agreement, the JCPOA, and as part of that agreement, there is a snapback sanctions clause, which would effectively allow any of the 15 members in the UN Security Council to revert sanctions back to the state they were prior to that agreement, which would mean freezing Iranian assets, a total prohibition of uranium enrichment for Iran. And that could mean that's some serious sanctions. So if the deal we're currently negotiating with the US and Iran falls through, and France, Germany, and the UK, who have suggested they're willing to pursue these snapback sanctions, go through with it, it could be a super polarizing kind of outlook for flat price. On the one hand, if there's these stronger sanctions, it could be pretty bullish. But conversely, if the deal is successful and the sanctions are dropped, it could be got 1 million barrels per day of Iranian crude coming back into the market. So it could be super bearish from that perspective.
Yeah, Iran coming back into the conversation. I mean, it's been, at least in my time in the markets, it's always been a lingering theme. Iran are capable of producing a hell of a lot of oil. We talked about it being very bearish for naphtha in terms of more supply there because they have so much condensate supply. Also fuel oil, Iranian fuel oil is a big deal. So the fuel oil markets are super hot right now and are very strong cracks. I mean, that would be a bearish factor. But I think we've got to look at it like on the skew of risk reward. Like Harry, you'll remember as well, right? Like back when we were like say Mandara days or early Onyx days, there was a lot of floating tankers from Iran. You remember talking about this, and we were always counting like, okay, so if Iran was to come back online, you've got all these tankers ready to go.
How much could they release from floating storage?
Yeah, and from what I'm seeing or hearing, it's not the case anymore. Right? They're quite well integrated. And my brother's in physical trading, and he loves saying like that Bane quote in Batman, where it's like, you were in the dark, or whatever. That's how you train. But I was born in the dark. It's like the Iranians were born in the sanctions. They've been doing this for like years and years and years. They've been integrating their whole system for a long time. And I remember I was even on a trip a while back, speaking to a Chinese independent refiner. Talking about dealing with the Iran is like, you'd think with sanctions it would be easy to negotiate, right? It's like, no, it's harder to negotiate with the Iranians than it is just like the normal market. Like they just get the best price they can get. Nothing's really, they know what they're doing basically. It's no secret, even though it's kind of all over media, but it's almost said in a hushed tone, like, you know, Iranian fuel going via Iraq and the Iraqi special blend was a thing for a while. Like, this is just so I guess on the balance of probabilities, I don't know how much really it's going to impact supply. Of course, a free Iranian market to export probably does obviously have a net bearish impact, but I think it's probably not as.
It's hard to know how much. It's hard to know how much they've worked around things at the moment.
Well, that's what I'm saying.
You're saying if they're born in the sanctions, like their job has basically been like, how do you figure out a way around this to keep things flowing? And like you said, like the Iraqi special blend, like we heard it with Russia, like you know, Malaysia exporting more product than they produced, and
stuff like that,
you know, things like that. Like the workarounds do come up quite quickly, and
so I guess that's, I would say then basically it's not the most bearish thing for the outright price. I think it's probably factored in. It's not like there's a flood of crude to come back like there have been in previous years. So I would say, you know, it has a bearish impact, but any kind of sell-off right now seems to be absorbed like it was on Monday, right? You had, okay, we could have a deal and then $2 lower. And our options trader is saying, you know, it was kind of skewed that way from a, I think a gamma perspective, but at the end of the day, it got absorbed and we're all the way back up straight away. And it kind of has that sense to it, especially with fuel markets so strong. They probably want the supply. So, but yeah, look, at the end of the day, I think it is, to be fair to say, that is what's driving the herd right now, right? People are probably looking at that as the latest headline. We don't need more tariff news. Like everyone knows, kind of the situation there. However, Besant is speaking today, and we've got one of those situations where we're talking before he's talking at like 3 p.m.
3 p.m.
Yeah, exactly. Yeah.
Who knows what's happened at that point? But I think we're going to presume that he might say something to create a bit of volatility, but we've got the headline fatigue. So maybe not the most bullish thing ever, unless he says I'm rolling back China. And obviously that would be great for sentiment.
You might have, I guess maybe today that you've released a bit of headline fatigue because like Trump being, what's the word? Like de-escalatory in terms of saying like, you know, tariffs will come down for China. I mean, that's like the first kind of thing he said, like to that effect, which is not just, you know, we're going to do like 1,000%. Like it was all just so like hyperbolic, everything he was saying, that now, and like knowing Trump, when he says that, is that him basically just sort of very reluctantly saying like, I've fucked this.
Yeah. Well, I mean, that is the whole thing, right? They asked the deal, start from an outrageous position and work back, and China are meeting him with that, but they're also hurting, right? Like, again, I don't want to belabor this point too much because everyone's reading this all the time, but you know, you're hearing that like Chinese manufacturers as well are hurting, right? They've got people calling up from the US being like, cancel all my orders. It's like, what the hell? Like that was like my whole thing. So it's not like people aren't both hurting, and there's culture wars, there's TikToks and all this shit going on. So I think, it's probably coming to boil that something's going to be negotiated behind the scenes. It's not quite the same as Russia-Ukraine, right? Because there's a lot of like, you know, deep tension there, you know, a lot of blood spill. This is a very dark thing. A trade war like this is, I hate to say it, but like a little more fickle. So when you talk about a golden bridge, you know, like two alpha males trying to act all hard and then like, okay, they don't want to seem weak. So you have a golden bridge scenario where you say, okay, how can we both look good in this scenario? I think that's more likely to happen in this than the Russia-Ukraine, right? Because there's just so much more at stake there. So I guess I could see what you're saying in the sense that like it doesn't take a hell of a lot for him to roll that back. It's not that embarrassing, right? You can always spin it. Whereas just to touch back on the Russia-Ukraine, I mean, maybe that's gone the headline fatigue again. That's kind of gone under the wraps. Yesterday, Putin saying, okay, I'll agree to a ceasefire again, and whatever the details are this time, and maybe that kind of creeps back into the narrative this week as well, which again, is it that bearish? I mean, we've got oil low enough for people to be freely buying Russia anyway. Right. They've integrated the whole supply. I mean, why did oil traders make so much money in 2022? You know, it's not because they're great gamblers like anything, but this is because there's a hell of a lot of volatility and it's a restructuring of trade flows, and that's where they make their money. But, you know, everyone rushes in to close that arbitrage, and you have a very well integrated system now with the way it is, because that's how quickly oil traders can react. That's what they're so good at. So just because Russia are free to come back online, does it make any difference? So they've got that weird scenario. It's still not really skewed to the downside from that news. But anyway, that's probably enough there. Okay, so now we're going to have a new section called Hedge Fund Watch. So yeah, what's the hedge fund positioning been, I guess, in the kind of headline Brent and WTI?
Yeah, so let's start with that. So this kind of our CTA model, which shows how cross-exchange traded futures, how players are positioned. We've seen sort of a little bit of a rebound from.
Jump ahead too much because we've got like an audience different kind of knowledge. So CTA, Commodity Trading Associate, it doesn't really matter what it stands for because it was an old definition.
Yeah.
But when we say CTAs, we just mean the basic trend following
algorithms.
Funds that are out there, which they do tend to dominate flows these days. So they're literally just getting long and long and longer, and then short and short and shorter, trying to capture the momentum. So they're a good signal when they're kind of overbought, oversold, and they're a good like just general signal about flows coming in. So it's always good to keep an eye on. So you have to take the managed money section of the CFTC report. So the CFTC publishing, this is how everyone, and ICE, this is how everyone are positioned in the Brent futures and the WTI futures. And they show you the hedge funds, if they're long or short. But within the hedge funds, you've got the CTAs. So our model extrapolates from that hedge fund positioning, how much of that is the CTAs, because the rest of it's going to be macro kind of portfolio, risk parity, and discretionary punting. So yeah, so let's strip that out. So CTAs, yeah, what have they been doing?
Exactly, yeah. So our CTA model has shown that in Brent, there's been a little bit of a rebound in positioning up to 28,000 lots, 28 million barrels effectively. So that was kind of a little bit of a bounce back from the week prior, which was the sort of the Liberation Day and the tariff news week. So a little bit of a rebound in Brent and similarly in WTI, but still overall quite bearish. The actual overall managed money position from the CFTC report, which is again kind of an aggregate of funds and everyone in that managed money category, has fallen and mainly been driven by a reduction in long positions. Also a small increase in short positions, but it looks more risk off sort of a week.
Yeah, I mean, you're giving like kind of like a gloom scenario, but it's actually like the opposite really, because they are under positioned, right? In the sense that they have a net short position, which is a pretty big deal. When the market has gone up from $58 on Brent to 68 now.
Right.
So they're still not flipped long. And we've got best sent today that we're talking about with China. We've got kind of bullish crude stats from last night at the APIs. It was all draws and crude draws and gasoline distillates. If that's confirmed today, and you've got a really strong Brent front spread, you've got a lot of bullish factors. This is pretty damn bullish, to be honest. If this now has to chase up and stop out and then get long on the back of their models, I mean, this kind of volume, you're talking about a kind of normalization range, probably around, let's just say for CL, for WTI, probably around 40,000 lots.
Yeah.
And then negative 30,000 lots.
Yeah.
26, okay, so
a lot of room to the upside.
Huge, like what did I just say? 20 to 40. So 60,000 lots of just WTI, maybe another 50, 60 in Brent. That's a lot of volume, 120 million barrels of buying to be done to get to like a normal kind of bullish net positioning. That will have that kind of virtuous cycle, right? Of like they're buying, increases the momentum, people are bullish, the sentiment, everyone's starting looking at the market and starting to give a bullish narrative, and all of a sudden you're in a bull run. To me, that's like a good $6-7 potential at least, I would say, which is pretty incredible to say, because I think we would have thought we're at the end of the 70s this year.
Yeah, like 2 weeks ago, we would not have been having this conversation at all. It was like, is it going to go above 60, or like, is it just going to keep dumping?
Yeah, this is the thing about the hedge funds as well. So this is like very strictly the modeling. Do we have the outright managed money position as well? So that's
this. So this one here is the in Brent futures, the overall managed money managed by money position in Brent futures. So that's where we're sitting right now. So a little bit of reduction in long positions, but still overall quite long. That do sound a little bit doom and gloom, I guess. Pug up a little bit.
Mate. Okay, so look, they are net long, the hedge funds on the managed money, but that is not surprising. It's generally the case because you have a lot of long only funds, right? A lot of passively long macro positions that are long, which we call people call risk parity portfolios, right? So you're long everything, bonds, equities, commodities, and you just go overweight or underweight. So if you're not that bullish, you're just not that long, but you're still long. So that tends to be why we're there. So if you look at the graph, I don't know if we can get it up. Yeah, that is on the. I mean, you can see it's a lot. In the last couple of months, it's the least long they've been. So that's another thing, they're kind of oversold, I would argue. So that's even on a discretionary basis and macro basis, basically hedge funds seem to be net short. Now that isn't speculatively net short or not that bullish. Now, why is that? Well, this is the thing. That's why I think we put in the Hedge Fund Watch, because you have to look at the financial oil market in segments, really, because the industry behaves so different to the hedge fund community. The CTAs behave in their way, and they've all got such big flows. So, you know, we're trading a combination of these things, and retail kind of has its kind of, you know, its influence there as well. But they are reacting to the, I would say generally, this is a generalization, but they are reacting to the analyst world. Now, the analyst world moves by consensus, right? And I think you had Rystad yesterday come out and say, actually, it's going to be bullish for a while in summer, and then it's going to come back down again. And, you know, this is off the back of JP Morgan, Goldman Sachs, all these like huge names saying they're now bearish. And it takes a hell of a lot for them to switch. And they were bullish all last year, well, last fucking 10 years. And then, okay, so now we're bearish. And it takes a lot for them to switch that, because it's embarrassing, right? You can't just be like, oh, I'm long, now I'm short, now I'm long, now I'm short. Even though that's how the market works.
Yeah.
They have to move in these like slow, like oil tanker way, excuse the pun. But the point is that the general consensus has been we're oversupplied. Supply and demand balances are negative in terms of people expecting it to be oversupplied this year. Now, this is the problem with these models. That's all well and good. People sell the hell out of the Brent spreads. The hedge funds sell flat price. And then you get a move and it kind of exacerbates it. But then it's not paying attention to like the incremental changes that can be so dramatic. So we have had a consumer-led like buying spree that I guess is being underplayed right now. We went down $15 in Brent and WTI. Now, you're never going to know precisely until the cargoes actually start moving, but all the signals are the Chinese came and bought the crap out of crude, right? So you've got all the Dubai benchmark, the data benchmark, the differentials are super high, the refinery margins are super high, which all suggests to me that actually the spot market, just there's not enough oil. Because when China come in and buy that much oil and freight starts moving up, TD3's on its way up, basically, yeah, it's all absorbed. It's all well and good saying we're oversupplied by 100,000 barrels a day. Yeah, well, if I just buy a 2 million barrel VLCC, like what are you going to say now with your balance, right? It can really shift so aggressively. So when they do these sprees, like fuck your balance, basically, right? Like you might all think that for a short period of time, but now I've just bought a hell of a lot. Did you factor that in? Did you factor in the price sensitivity? And the how aggressive these consumer buying can come in? And I think it's the fuel oil market as well has had a hell of a lot of buying. The airlines have been buying a hell of a lot. So but you just got to say, like, the market's kind of been shocked to the upside from an actual physical point of view. And so, you know, you've got hedge funds and analysts that are going to be hanging on to this narrative, and the hedge funds, I would argue, probably going along with it, but no, okay, well, that's the general consensus, so I'm going to stay short. And you're missing like a $10 rally, and then you're probably thinking, oh, you know, Trump, whatever, but pretty soon we'll be at $70, and then the whole narrative changes, and this is what gets me kind of like fed up, because then you have the media chasing those headlines, and it's like the analysts always said it was bullish, and oh yeah, this and that, and so they're kind of chasing their tail. And then people get quite upset in the community because they're like, I'm being led down a garden path here. So I think it's kind of like messing things up. And we said last week the hedge funds not doing very well. They're definitely not doing well again this week, and they're probably not going to do well for next week. So I would say they're going to be pretty pissed off with analysts and all that. But you know, you should never kind of chase consensus. Anyway, so that kind of summarizes it from a headline crude perspective. But, you know, hedge funds are also in the product game. What have we heard, Harry? Like product positions, for example, in hedge funds?
So, yeah, we think that hedge funds are probably long RBOB to heat.
Yeah, that's been a trade, I think, for generally for this year.
Yeah,
being on that.
And probably long RBOB cracks more recently as well.
Yeah.
And even EBOB as well, maybe.
Yeah, so summer buying generally
sticking to
like
futures, but
yeah.
Like we know that the funds will like participate in like the EBOB cracks as well as the RBOB cracks. But yeah, RBOB to heat has been the trade that we were talking about yesterday.
Yeah, so it's clear that's RBOB, so US gasoline versus US diesel, RBOB versus heating oil.
Yeah,
it's quite a common spread to trade, and it's just basically, you know, how would you kind of explain that relationship? Like diesel is a good proxy for economic demand.
Yeah.
And I would say tariff suffering, it makes sense to be underweight diesel and more bullish gasoline. Because like you were saying, either last week or the week before, lower prices on an outright basis spurs demand, right? And we're coming to summer. So there's good reasons.
And in the US, you don't really have the same diesel demand that you might get in Europe. So yeah, like you say, the heating oil is more indicative of, at this time of year, like, economic strength. And if people are sort of driven by a bit of uncertainty with what's going on, but you've got this lower flat price environment driving gasoline demand, then long RBOB to heating oil makes sense as a trade, and it's a good expression in the US.
Yeah, this reminds me of the beginning of last year. We had sorry, I need to get this right. I think it was the beginning of 2023, actually. We had Q1 being like, well, there's not a hell of a lot to do in the outright prices for hedge funds and speculative traders. So there was articles coming out because there was like record open interest on the product futures and the product swaps and stuff we trade. Because everyone was saying, well, if the outright price isn't going to be interesting, let's buy all the products. And the reason, I guess, that was touted the most was when we get to summer, you've got all this peak demand, gasoline and other products. And there've been so many refinery breakdowns and fires, and with the narrative of the temperatures getting so much hotter, global warming, all the rest of it, it was actually a relatively high probability thing to happen. But of course, what happens is when everyone prices that in and it doesn't happen, it's obviously goes the other way. And then you have a herd, kind of the downsides of a herd, which is everyone clambering over each other like Simba. And then,
like the move happens so much before it should have happened.
Yeah.
Like everyone looks at margins and they're like, well, now I'm going to assume that every refinery is just going to be broken basically for the next 5 years.
Yeah.
So we should be long like refinery margins, and then all the refinery margins start to price that in, and then things start to happen. Or like
so everyone speculated on summer in Q1.
Yeah.
It really rallied the cracks. It got priced in. Refiners like, great, selling the hell out of it, hedging forward. And then it's not going to happen when it's so well advertised.
Yeah.
You don't want to be buying when everyone else has already bought. You want to be buying whilst they're buying and getting out at the right time, which is easy to say, but when it's so well advertised, it's always a dangerous thing.
And that wiped hedge funds out last year.
That has been a narrative, but then it stopped because it didn't happen. But I think this is how it always happens, right? When you stop thinking about things and your attention turns away, it actually looks like we've got that scenario again. Refinery margins are very strong. Crude is very strong. So utilization is going to really be as high as it can be, really, from refiners in the US and refiners in Europe. So everyone running flat out. And if we have a hot summer, there probably is a risk of refinery breakdown. So if you're bullish RBOB anyway, and you've got the summer and it's underweight, right? It's not like a hugely long market in gasoline. It's a great time to be long and kind of keep this long positioning. And if you buy RBOB versus Brent, the refinery crack, it's actually a good kind of proxy for being short Brent if you don't like being long Brent right now. I mean, buying RBOB versus Brent is actually quite a relatively good relative value trade, I would say. And if we do get the refinery fires and the refinery breakdowns or any sign of it, you're going to get a lot of people rushing in. And so that could be quite bullish for diesel. But that to me is the only real like standout potential bullish factor for diesel. So I would still say it's better to be long RBOB rather than diesel. Hence, I think maybe RBOB versus heating is quite good and people are doing quite well out of that. I think it's definitely rallied. Okay. And I think the only other place I think we've heard hedge funds be positioned is probably a bit of Brent Dubai off the back of like the OPEC news. And Brent Dubai has been very volatile. I think we called for like a long Q4 position, which has worked out quite well because the whole point of it was quite low volatility because it's a bit down the forward curve and you don't get all the shocks of the spot market. It's still been volatile, but less so than the front. And we've actually got, this is actually rendered by itself. So you've seen like this big rally kind of at the beginning of the month. There was a decent amount of stop outs, but it has found its way back down again. And it's a bit of a tricky market right now for Brent Dubai, but I think there's some positioning coming in speculatively on the long side for hedge funds, which I think makes sense. If you want a long-term normalization trade, Iran coming back online, OPEC coming back online, you've got such a good risk reward. We're negative on Brent Dubai, as we said last week. The usual levels are $3, $4, $5. It's a generally quite a good trade. And I think that pretty much summarizes Hedge Fund Watch.
Yep.
Now let's hone in on the contracts where people have made money. The gold rush. So what are we thinking, Harinder? Geek in the seat?
Yes. Yeah. So there's a few contracts that we think this week players have done pretty well on. The first that we have to mention is the prompt Brent future spread. That would be June, July Brent futures. So if I pull it up on my chart now, we can see that there's been a pretty aggressive rally up from, down here in the early April, where it was trading around 40 or so cents per barrel. And we're trading very, very, very close to $1. So the initial trend, if I zoom in a little bit, was kind of a slow, kind of gradual progression. In the last few days, we've seen an accelerated, more accelerated trend, which I've shown with the second line going upwards. Yeah, so this is kind of, like you said, off the back of pretty strong. So the Brent spreads are like a representation of the physical, the underlying physical. And given what we've mentioned before about physical being so strong, it makes sense that Brent spreads are so high. I think, yeah, we said as well last week, even though Brent was coming down, the spreads were maintaining a really strong levels. So they were like, even when Brent was selling off massively, spreads were kind of ticking down very gradually, and now they've picked up and we're closing in on $1 per barrel. So yeah.
Well, it's just a physical reaction. Everything we're saying, we had a massive consumer-led rally, a consumer-led buying spree off the back of low prices. Listen, that's pretty much it. And unexpected buyers coming in. So crude had to rally because, as in physical crude, spot market crude had to rally because there's not enough crude and the refinery margins are so good and they're the buyers. So it just made sense for it to be a buy. But in the back of all that news going on, you can forgive, in particular, hedge funds for selling out of all their length or getting short Brent spreads, the short physical, because it's a reflection of supply and demand. But massively caught out there. And what this is screaming to me, I've already said this on this podcast, but when you see such an orderly rally like this, it's actually quite rare. So it means someone is losing money pretty big time, because you need the liquidity from the other side. If everyone's chasing the same position, like we've seen in the last few years, because everyone's in this market to be bullish in the last few years, finally that consensus change and people get short, and they're probably selling on the way up as well, because they're thinking it's a dead cat bounce and tariffs. And all the while, the physical traders are going, cheers for the liquidity. And it's just been like serious volume. I mean, every time we have a dip, you have these like rock solid bids in the spreads, and you're just completely breaking the correlation with the front spread and the outright prices. Crude comes lower and the front spread doesn't even care. And it's just creeping up and up and up. You've had a few like resistance levels, which I would just say is pretty clearly some profit taking, like 95 seemed to be a clear one. We finally broke that last night. Okay, we're 101. I think we might be trickling down again, or 98, whatever. The point is that it's been orderly because there's been so much volume that the physical traders haven't had to compete with like they usually do. And so, yeah, that obviously means someone's losing money. But the other weird thing about time spreads, I don't want to get all technical here, but it's worth like pointing out like how the dynamics work, because you have an outright long position from hedge funds, right? And like we said, the managed money is always net long. It's just how long are they will kind of dictate your kind of bullish bearish. So in particular, these funds have to roll these positions. So hedge funds rolling, selling out their outright position and buying the next month, they need liquidity for that. And that is a key liquidity event, right? And they're selling a lot of volume, talking about hundreds of thousands of lots. And so what will happen is, if the physical traders, or the trade houses, believe that it's weak, and they know these hedge funds are going to be selling, they're probably already short and using as liquidity to take profit or just to write it down, or they're taking it. So it's a good indication when there's hedge fund rolling. And there was probably a lot of panic rolling in the midst of the crisis, the Liberation Day. But you could just see everyone wanted that liquidity. So it's in like you're seeing blocked trades in Brent futures, which is quite unusual. Usually everything's done on the screen, but if you can actually see block trades, which means, a trade with a counterparty via a broker or direct, as like 5,000 lots, because the trader's like, give me the volume. Like, I actually need the volume, and I don't want to move the market. I don't want to keep lifting the screen, because if I buy 5,000 lots, it's just going to fly with all the algorithms. So if you can sell me at market, you're done. And you've just seen that orderly buy. And but I guess my point is that the hedge funds won't see it necessarily like they're losing money if they're rolling a position, because they're just rolling it to the next month. But if you do the maths, like, if they're giving it up the spread cheap, they won't see it that they're losing money, but the money has to be transferring to the physical traders if ultimately the time spread rallies. They're the ones that have given up that thing. So it's just worth noting, like, the hedge fund role is a money transfer, and it's a really key one to look at if you're trading time spreads and if you're trading kind of the global markets in general. So we're pretty confident that the industry is making money. That's why you brought that one up. What else have we got?
On like a lot basis, if we think about from the last like 10 days or something, on a like if we think how much volume these guys might have on, if they've caught like a 30-40 cent rally in the last 1-2 weeks, you know, these guys are going to easily have like 100,000 lots on.
I think the top trade houses will have 100,000. I think like 2 or 3 of them will have that position. Then you got the majors. You should probably like a net speculative long position of like at least, oh God, I don't know, but let's say 500,000 lots, which just sounds so big when you say it, 500 million barrels. So yeah, 40, 50 cents, 250, 300 million being made, being long, and they'll carry that all the way to expiry. And that's the other thing about time spreads. If you carry them to expiry, it's cash settled. So you don't ever have to liquidate your position, which is another competitive edge over hedge funds, because they have to eventually exit. So they need liquidity to exit. Whereas the trade houses are going, I'm literally going to ride this all the way, and I'm going to be involved in the settlement index, which uses physical. And if the physical's strong, I'm going to be buying that physical, and it's going to settle high, like job done. So it's a great environment right now for trade houses. And look, I know this is another generalization, but bullish Brent spreads is great for the North Sea trade houses. Like they do very well with a bullish market, especially an orderly bullish market like this. So I would argue they're probably having their breakout month this year off the back of this. So yeah, you're talking hundreds of millions being made. Yeah. What else are we saying? Maybe more of the niche kind of products we trade.
Yeah, so let's take a look now on my screen at the May-June Sing 10 ppm spread. So what this is the Eastern sort of diesel benchmark, and it's the May-June spread. So we've seen a pretty aggressive, I guess it's an orderly rally over the last few days, but it's been very, very steady upwards from around 43 cents per barrel to on the 17th of May up to about 74. And since then, we've seen a little bit of a sell-off, which could be profit-taking by trade houses. Another interesting sort of thing about this underlying is that end users, like airlines, like to take advantage of when flat price is pretty low. And so what they might be doing is buying sort of like the gas oil contracts, buying kerosene, and particularly the combo, which is a contract which involves buying the gas oil east-west, which is a differential between the Sing 10 ppm and low sulfur gas oil, European low sulfur gas oil, buying that, and then also buying the regrade, which is the kerosene versus the Singapore gas oil, exactly. And so the combination of buying in both of those contracts means that they effectively get an exposure which is long the kerosene versus Western gas oil. So I'm going about this quite long-winded, but it's basically trying to take advantage of a low flat price environment.
What the hell is
and
that?
You lost
hedging.
me a combo.
Yeah, no fair. Just trying to hedge at low levels, basically.
Basically, yeah, it's buying jet over diesel. Incrementally, it makes a difference because when you're refining crude and you're making diesel and jet, there's not a huge difference with the molecules. It's basically a blending difference. So when you get, a big price difference between jet and diesel, people are incentivized to switch, right? And try and produce more jet over diesel and vice versa, right? So that's basically what you're saying, right? So they've been that spread has gone up, right?
Yes.
So jet has been basically been bought up, and it's a way to express a long jet position. Like we were saying earlier, RBOB versus heating oil. These spreads are quite interesting because, jet versus diesel is niche, but it also makes sense as well because a lower flat price environment, loads of airlines coming in to buy and hedge and consume lower prices. It's great for their economics. So it makes sense on a relative basis for jet to outperform diesel, which is more of an economic indicator, trucking, farm, agricultural, that kind of stuff. And if there's a lot less industrial activity, then it makes sense for diesel to be under pressure relative to airlines. But airlines, there's still a hell of a lot of travel. I mean, I don't think that's slowed down. So it's quite a logical move that jet's going up relative to diesel, and that's just what they're expressing, right? But I guess it's interesting that they're doing it in the Eastern market more than I guess the European.
Yeah.
Yes.
Could it? I guess perhaps it could be. Could it be as a consequence of like? Can't really think of a reason in particular.
Our top analyst at work there.
Yeah. All right, I don't know.
So what do we have from any more data on that? That's just basically saying that it's been an orderly rally as well. Do you want to get up the graph?
Yeah, so this is the 10 ppm, the prompt spread in 10 ppm. So we peaked at like
Sorry, yeah, guys.
at 74 cents a barrel. Since then we've sold off a little bit, which the distillates desk think would be profit taking by trade houses. So it's still very, very high.
Yeah.
Yeah, and that's why we think it's pretty much gold rush, been very steady on the way up. And some
Again,
profit
yeah,
taking.
good point.
So generally, like across markets, including Brent and all this, there's a bit of a pattern where these front spreads have done quite well.
Yeah.
Where, you know, especially on like that kind of end user markets like gasol, like gasoline's done well, like Brent. Do you think that this is again like could be driven by like a lower flat price environment? Because I remember like when I was trading fuel, people used to say like on the lower flat prices, like the front flies can perform because the front spreads, you create demand in the front spread, and like the back end spreads are more correlated to Brent spread. So you have these like flies strengthen on like a lower flat price environment. So feels like, you know, I think we're going to make the same argument soon on that naphtha spread, but these kind of front spreads, like a lot of the kind of money being made at the moment seems to be on like the front spreads rallying on like a lower flat price environment.
Completely with you, which I think it's been really surprising, right? Just how much consumer buying there is. And the other indicators, yeah, fuel oil, like you said, right? So it's like if you learn the players and how they act, there's a big hedging market in fuel oil, isn't there? And we talked about this again last week. Why? Because fuel is usually a waste product. So you get a lot of like hedging on the sell side from refiners, but you also get a lot of consumer buying from shippers who, like airlines, need to keep buying. So they like it when their economics dramatically improve, like almost overnight. They're going to lock that in, like, 20% reduction in their fuel prices. They don't have to make their ticket sales or their chartering rates so sensitive to that, right? So they can basically just get a discount. Like, so of course they're going to lock it in. But that buying, like you say, then shows itself in the contracts in the front, and it makes complete sense that the time spreads would rally. Our fuel oil trader was saying, like, this was a long market in fuel. It's probably another gold rush, and everyone's doing very well, but he's so surprised just how much the market's been able to sustain these high levels. But I guess he hadn't factored in until recently there was way more buying flows because the consumer, those are the guys that weren't there, let's say 4 or 5 weeks ago. So they were new buyers to come in and help their prices be elevated. So what does that do? That de-risk the long that want to sell, de-risk the longs that want to take some profit or de-risk their position. It also adds weight to generally the spot market, which is just a generally bullish sign. So it's kind of healthy for longs. It was like exactly what they needed, basically. It's already rallying. Then you get a flat price dip and they just like super supported. So I completely agree with you. And then naphtha is another one. And I think you're about to talk about naphtha.
Exactly, yeah.
But naphtha is another market where it's a really important one because it's used to blend for plastics, petrochemicals. It's also used to blend in gasoline. But generally speaking, you get the same thing. You get buying coming in on a lower flat price because they just got a discount for their feeds. So that's a lot with the Chinese. They're quite sticky buying naphtha lower or butane lower or whatever. So as you say, it's the same thing. Like the time spreads in the front kind of have to perform, assuming the market isn't oversupplied.
Yeah.
So of course, when you get flat price dips and there's enough oil, then there's buyers, but it just gets flooded. This is a great signal that there's not enough oil out there because every product spread is rallying and every time spread in crude is rallying. But go on. So naphtha, what's going on there?
Yeah, so if we take a look at my screen now, so this is the price action for the naphtha spread on the screen. So we've seen a pretty, like you said, after about the 4th, 5th of April, a very orderly rally upwards to about $8.50 per metric ton. So yeah, I mean, in terms of positioning, we've seen in the past week about 500,000 barrels of trade house buying. So if I flip in our COT data, so this is the May-June naphtha contract. So here we see that there's been, yeah, we go. So trade houses have been long throughout basically the last month. But in the last week, we've seen an addition of positions on the kind of the 14th, 15th of April upwards. So that's about 500,000 barrels. They're over 2 million barrels long in total, and about 180 kb of fund buying as well. So, and that if we take a look at those positions, we can get an approximate idea of how much they're making. So, assuming they entered around $4.75 per metric ton back in early April, and the spread trading around 8.25 as we saw. Look at the chart again. Now at 8.50, even higher. They're sitting on gains of at least $3 per metric ton, which works out to about 500,000 on their 1.1 million barrels. I mean, it's traded even higher since doing this analysis. So chances are they're going to be even higher, and that's a conservative estimate given they entered around 475, and that we were trading at 825. So a lot of upside there.
Yeah, good summary. I think what surprised me about the naphtha market is you've had a short crack position from the trade houses and a long spread position, and that's a reminder that different trade expressions for different things, right? So they bearish naphtha versus Brent, the crack refinery. You know, who knows why, right? Maybe on the back of basically the other crack's too high and it's a relative value thing or whatever it is. So there's definitely been a short crack position by trade houses, or the sentiment's been bearish there. But yeah, to be long time spreads is a bullish physical thing. And I'd say, as you're saying, that they're kind of generally long that and doing well. So it's implying like a short back end crack position. But either way, that's not that common. They usually kind of get a correlated, they're short cracks and a short time spreads. So to have that difference is quite interesting. But yeah, maybe we'll find out the reason. These kind of things materialize later on. You learn why later on because no one's going to talk about it whilst they're in the trade. But yeah, no, that's a good summary. Okay, now to where people have lost money. So this is the widow maker. So I would say generally, industry has done well, I would say. Hedge funds not so. That's kind of our summary at the moment. But what have you got for anything in the industry you think people are losing money?
Yeah, so I think the Brent Dubai has been a really kind of interesting contract to follow. It hasn't behaved in the way we would have expected given the Saudi OSP cuts and the addition of OPEC barrels. You would have thought that the Dubai benchmark probably would have weakened off the back of, you know, the supply, the increase in supply, and also the prospect of potentially having Iranian barrels back online as well. It's been kind of behaved anything but compared to what we thought. So if we take a look at the May Brent Dubai contract on the screen,
It's rallied.
so it's picked up recently, but in the past sort of week and a half, it's come off on the back of Dubai.
I get what you're saying, but we had a big rally off the dip, and in a short market. So I think we've talked about this before. You know, trade houses have been long this for years, and it makes sense to be structurally short this. So I say they've been short this for a long time,
right?
Because it makes sense to be structurally short on the back of OPEC cuts. So whenever there's a rally, you kind of just sell into it, and they're comfortable taking it into pricing to the settlement because that's when the physical kind of converges. And they're very confident that that's how it should play out, as in it should play out short. So that's done well for them. But yeah, as you say, the OPEC quota scenario, the Saudi stuff is genuinely a change to the physical market. So I think there was stop outs in the trade houses. And that's what you're saying, basically, right? They suffered on the way up.
Yeah.
Actually, no, it's not what you're saying. So what did happen.
Yeah.
But it's kind of come back again.
Right.
And that's hurt the new long entrants. But I would say a lot of people are still in the trade. I wouldn't say it's kind of played out yet. So it's an interesting one, like you say. But yeah, from a trade house perspective, I would say they're in fight mode. But just to follow up on what you're saying, yeah, of course, OPEC, bearish factors. But again, the Chinese demand, right? They're going to more likely buy Eastern cruise before Western,
right?
Just more local. So I would say the consumer-led rally being definitely led by the Chinese and the biggest volume players there. Does make sense that the Dubai market will react off the back of it, but I hear you. It's unexpected still for it to be so absorbed. But yeah, I mean, what about the price levels? Like, what are you actually talking here about? What's been made and lost?
Yeah, so if we take a look, so given trade houses enter around 75 cents per barrel, I'll pull that up.
But that's like over what time period?
So that's over the last 90 days. So it's a much longer time frame that we're considering. So this is the May Brent Dubai. Again, another thing, open interest wise, is quite interesting. We're not actually near danger levels yet. We're sort of maybe a little bit above the 5-year max, but there could be some room for additional contracts to come in, additional players to enter. But if we're going down to entry level, so over the last 90 days, the short players that have entered quite high, so they're pretty comfortably in the money. That's 90 days, of course. If we go to 7 days, entering a lot lower, right? So these are the trade houses that have added the more recent positions.
Yeah, some selling on the way up, but as I say, it feels like they're in fight mode because when you're trading the prompt contract and you've got such big volume on as a trade house, you know, they do stop out, I think, for sure. But generally speaking, when the whole market's trying to buy, or there's a lot of people stopping out and there's new entrants coming in, when it's so prompt, it's actually a very bad idea to stop out when you're that big, because you're just going to hurt yourself by lifting every level, and then everyone's going to try and get ahead of you, and it's just going to be a disaster. So you're better off. It's actually less costly to kind of protect it, right? Sell more volume and then get into the physical, which is only a month away, right? So it's a May position, then you have to wait a week now, and then kind of sell the physical they own in the window and kind of try and offset it that way, or at least keep a lid on it, which is again is another factor at play when you're trading these contracts. You can't just assume that it's just really sensitive to supply and demand. It's sensitive to people's positioning and how they want to act. So I would say what's going on right now is, if they're still short and they're still fighting, it's definitely bearish May Brent Dubai relative to other contracts. It's bearish the boxes, right? So we like being long the Q4. We've said this a few weeks ago. I think it's still a good position. I think you want to be short May versus Q4. It's quite a nice trade, because you should expect the trade houses to keep protecting this position. And if you're comfortable taking it into pricing, you can do that relative about being long-term long Q4. Because another tactic they'll do is, well, and it's what anyone would do, right? You're short the front and you need to protect the front, but you don't believe in the position anymore. Then you start buying contracts down the curve. And you're probably going to get more volume there as well, because you get a lot of hedging in the back end. Like refineries in particular, there's going to be people trading Brent Dubai who are not so fussed about it speculatively, so they can give you the liquidity for you to enter that long position. And it both protects you, both protects your short position in the front, and it also allows you to be long off, like when you come out of that May position. So as that expires, you're now long Q4. And let's say you believe in that position long term, you're in quite a good position. So you can actually end up making money both ways. And this is again when it comes back to trade expression. Like, you want to get on this trade, you just got to look at the risk reward. Like, people are short this market. It's not necessarily okay, so buy it because they'll stop out. Well, what if they protect it? So you want to buy something in this environment which can't be protected and is long term, makes sense. That's Q4, right? So that's kind of how I summarize that. Okay, let's do our section called the deep dive.
So yeah, this week it's really been about the Eastern fuel oil complex. So we've seen a lot of strength in East-West structure, but also just the 380, the Eastern fuel oil, high sulfur fuel oil contract. So if we take a look at the spread, the June-July spread, a little bit more deferred, the Sing 380 June-July spread on my screen here, we can see that it's been quite a strong rally up. Again, spreads, as we said before, have performed quite well. They've picked up so from around $8 per metric ton, $15 per metric ton in the space of a week. We think at these levels, there might actually be room to the downside from a technical perspective, firstly. So the RSI has crossed above sort of levels around 80. It's coming on its way down. It's about to cross below 70. So there could be some reversion downwards. In terms of positioning, we saw trade houses flip short. So if we pull up the 380,
this is in 380 East West or
So I was talking about the prompt spread, the 380, the June-July
380.
So just for context, there's been a big rally in fuel, right? So it was led by, as in the Singapore market, was what led this initial rally.
Yeah.
We've now gotten so high and so sustainably high. We've talked about this, haven't we, quite a bit.
Yeah. The June-July spread has been the one that's really like broken out. I think the May-June spread is about what, $9 or something. So yeah, for whatever reason, June, July, and I think maybe July, August as well, has been the spreads that they initially, when I say they, the bigger market, guys, the general market, kind of came after.
And it's performed really well. So I guess it's just showing signs of exhaustion, right? Basically, as we said, we've had a lot of buying from consumers, but I would argue, and I'm not a fuel expert, but I would argue that there's probably more opportunistic bunker playing buying, consumer buying on lower flat price in Europe than there is in Asia. I mean, Asia, you get quite consistent buying. It's like the pump station of the East, right? Yeah. Everyone parks their ships in Singapore and they refuel.
Yeah.
So you tend to get like quite a lot of consistent buy side hedging, but Europe a bit more opportunistic. And if Europe is now buying a hell of a lot just on the financial side to hedge, it's kind of catching up with Singapore, right? So we're talking about a relative value trade here, like Singapore 380 versus, so the East versus the West fuel oil, that kind of differential and that time spread is basically weakening on a relative value basis, and that's kind of what you're getting at, right?
Yeah.
Like it's had its move in 380. We've had all the strength in the world. It's actually Europe that's catching up now because it's got some new buying, and it makes sense for the two to converge. That's essentially what it's about. It's quite a niche expression, but it's quite an interesting one. And as you say, if there's actually some people profit taking and getting short the 380, it's quite a nice trade to be short the east-west and short the east-west time spreads.
Yeah.
Do you want to just show the technical side of that? No.
Yeah, so if we take a look at the chart again, so there's a few different ways to express this. The one that I'm showing here is the time spread on just the Sing 380. So it's a very, very similar sort of profile with the 380 east-west, the time spread on the 380 east-west. But for the just for the 380 here, so we can see that the price action has trended significantly above the 14-day moving average. The RSI went well oversold and is now on the way back. If it crosses from above 70 to below 70, that could be a bearish indicator to watch for. But I think, so compared to historically where it tends to be, there's quite a lot of room for downside for it to revert back to levels we've seen historically around $7 per metric ton. So yeah.
And this kind of market as well, when you've had such a move up, and it looks like in the positioning that cracks, trade houses are getting shorter, time spreads, trade houses are getting shorter, like you can get like a pretty colossal sell-off when all of a sudden everyone starts to be like, oh yeah, shit, like 380 cracks are positive.
Well, if you've been on the sidelines and you've got some risk, it's quite a nice trade.
I would say there's probably quite a lot of people in that market looking for a time to get short, looking for the entry to get short.
Yeah, they've made their money. They don't mind. You know, they're never going to turn down an opportunity to make more money, right? So I think you're probably right there. There's some opportunity.
Yeah, like and if you've made money on the way up and now you're thinking like, there's an awesome opportunity to make money on the way down now. It's quite rare that you get something that can, on the face of it, can look like such a no-brainer, like shorting like everything at all-time highs, basically.
Yeah, you've got the risk to do it, and your risk reward is
you've got a lot of P&L to play with.
I've got to say as well, like this is not a dig at anyone because I've done it myself, but I have heard people say and act a certain way when they make a market call. It's just pump chest time, right? They're like, no one's better than me. I'm gonna live forever, and they feel like they can time everything, and you can see it. Like you just feel like you can see the market like a beach ball, and so you're like, well, now I'm gonna sell, and the market's gonna go down. It's like I've heard people. It's like a symphony. And look, it's good to be confident. You just gotta rein it in to some degree. And as you say, if you're getting short here, but you're saying on a risk reward basis it's strong and you structure it well, there's absolutely nothing wrong with that. But I've seen like horror stories. I've seen it quite a lot in North Sea market actually, like particularly like one trade house absolutely cleaned up on the way up and he's taking profit. It's like, right now I'm getting short, but the market had just caught up to this bullish move, and now all the other trade houses were like, right, let's get long now, and they just completely took I think they lost it all that they made on the, and that happens. And I think the hubris can kind of get on you, and it doesn't make sense.
Yeah. You forget that catching a turn is a contrarian way of trading. Like you talk about it a lot in your book, but like when you're trying to catch a turn like that, you have to, like you say, rein yourself in and remind yourself that like the market has been going up, and in this case, like exponentially, like just because you think it's turning, like you're trying to catch something, like basically you're trying to sell the high, and if you trade for any amount of time, like how difficult that is. So you have to remind yourself that this is not just because you want to pile in because it's an all-time high. That doesn't mean that everyone else thinks the same thing as you, and like you're selling into a market that's been super strong and you've been making money on it just because you decide that now it's time to sell.
Completely.
So in terms of like capital allocation, like you don't want to be throwing all your eggs into that trade because, like you say, there's enough people who could just be like, well, no, it's still rallying. Like, why?
Well, our first boss, right, Alf, he absolutely drilled this into us, right? And he was a big fan of Paul Tudor Jones. And Paul Tudor Jones, you say, he made a lot of money over the years catching the turn because he was a great contrarian trader. And he was very good at the trade craft of that, right? Selling smalls and stopping out, smalls, stopping out, and eventually capturing it and scaling in. But he said he just never made money in the meat of the trends because you've caught it. And as you say, it's rational. The market's rational now. It was irrational. I caught the irrationality. It's now rational. Cool. It's time to take profit and maybe even go the other way. But as you just said, but the market's catching up, and it's better to keep reminding yourself that the market is always in a state of overbought and oversold. And I love that quote, which is a Gartman rule quote, right? That we used to get that.
Yeah.
And it's a really important one because it's the same kind of mindset of run your winners and cut your losers. Like, you've got to run your winners, but it seems the whole reason you got into a trade was because the market was being irrational and you captured that. It's just so hard to tell yourself, now capture the irrationality. I don't think I've ever done it, to be clear. And I don't know how many people have, to be a contrarian trader and then turn it into a trending trade.
Yeah.
I mean, how do you, that would be so phenomenal to be able to capture that entire length of it. But so I wouldn't say you should be trying to do that, but you should be trying not to allow your hubris to then be contrarian trade again when you've just caught the contrarian move. Like, that is way beyond the odds. We're talking about a contrarian move happens, I don't know, depending on the market, but every so often. It's not a regular thing. That's a very volatile market. So I mean, this is going to be obvious to professional traders, but anyway, it's a great point. But just to kind of finish off what you're saying, it's a nice niche trade. And I guess this is the other thing, like, we're talking a lot of jargon, but you can reach out to the guys in Onyx Markets and basically ask them what these guys are talking about. Can I have a look at that? Where's that contracts? How would I do this? Please, if you are interested in what we're saying and you want to trade it for yourself, go and speak to the guys. They can really hold your hand on this. If you want it, if you don't want it, they can at least point you to the contracts themselves, get a price. And it's an interesting one. It's an interesting layup. Of course, not trying to give any advice. It's just generally just want to make the point that this is the whole point of Onyx Markets, right? You're trading these niche contracts. There's loads to do. There's loads of interesting things to do that I don't think exist in any other brokerage. So
I think as well, to add to that, like, a lot of what we've talked about today in terms of like the, even the complicated stuff like the combos, like the jet fuel diffs, it's nice that they're quite uncorrelated assets to what you'd usually trade. So, when Brent's selling off, when equities are selling off, generally people's portfolios are losing money, and it's kind of hard to be like, what do I do? Do I just like buy or sell the outright price? But with a lot of these contracts that we're talking about, it's a much nicer way of expressing a view on the actual market, which we're giving information on.
Yeah, and the economy.
So
people don't seem to realize when we're talking, it's like, we're not talking about some niche market that's like doesn't exist. We're talking about the global economy. Oil is the most important fuel in the global economy, no matter what anyone says. So when something happens in China or generally the East or anywhere, it's going to be in these relative value trades, this versus this product versus this region versus this, constantly punting the outright price. It's just not, it's a mug's game. Like, everyone in the industry says that. No one makes money long-term punting the outright price. It's in these differentials and time spreads. The risk reward is very strong. And I guess, let's not labor this, but I guess in general, why? Because there's a lot of hedging liquidity. The hedgers don't care if they make or lose money, because the whole point is they're trying to fix levels for their fuel prices or whatever they're trading. And these things can be held into settlement and cash settled. So you don't have the problem of like liquidation or as much. And you can just trade these and they can behave very rationally. Of course, irrationally as well, sometimes like any market, but that's what you're saying. It's a very nice expression. It's decorrelated to everything that's going on.
Yeah, exactly. Which at times like these, people are looking for like uncorrelated assets, because if you, like you say, you're either just getting wiped out or making loads of money on equities and outright Brent. But actually, it doesn't have to be that way. You can trade these things where you can express, like we said, even higher fuel demand on a lower flat price. That's quite a rational argument to make. And these are the contracts where you can actually express that. You don't just have to be like, well, when can I buy Brent when it's going to turn?
Anything happens in the global economy, no matter how like niche or what area, there's a way to express it with these contracts.
Exactly.
You just got to be patient though. Like, people like logging on being like, oh, why are the spreads like 1 cent wide and like moving like this? That's just not how you don't want that, because that's an algorithmic market that's going to run you over every second. This is a nice orderly, like, wider spread market because it's OTC and whatever else, but it moves a lot more orderly. Anyway, we've made the point. Okay, now let's do the crystal ball. Okay, so Brent flat price, Brent time spread on the front, gasoline crack, and the Asia kind of low sulfur fuel oil market versus Brent. So those are the ones we use when we say the general like view on the overall market. What are we saying? Brent still bullish?
I think it's still bullish, Brent, as well as the Brent spread.
Just have to keep riding that trend.
Everything's
pointing that way. Momentum, refinery margins, physical spot market. The new bit of information that we're introducing is the CTAs. They are still short.
I was going to say that point kind of backed up.
Pretty massive, right?
Yeah,
I mean,
yeah.
That's. But once that starts flipping, I mean, again, it was funny. We're talking about contrarian moves and whatever.
Yeah.
But once that starts flipping, it's a good time to take profit.
Yes.
But it's also a good time to run your winner. So, like,
Yeah.
But I'm looking for that to start being like, okay, let's how are things going to play out from here and take a breath. Gasoline crack, I guess.
Yeah,
Maybe slightly harder. Are you still bullish that?
I would still be bullish the gasoline crack. Yeah, I think maybe a bit more of a niche one, but I think if with Trump saying what he said overnight about tariffs, I feel like that hopefully would put some confidence back in the market. Like the stats last night show like
storage in US stats.
Storage in US, I think it's like 1 or 2% lower than the 5-year average on US gasoline stocks. So yeah, it feels like, I don't know. And then positioning has still been quite bullish as well. So I don't see a reason why.
Yeah, there's not much. There's not an over invested market in gasoline. That's very fair. My only concern would be that and the VLSFO versus Brent when we do. The same way Brent flat price going lower, more demand, the spreads all rally, the cracks rally. It's the same on the upside. So if we start breaking into the mid 70s, if we go that aggressive, I think there has to come a point where it's the opposite, right? And there's now getting into inflation territory and the consumer buying dies dead. And probably refineries think this is a good time to hedge. And those product prices versus crude start to compress. And that would be my concern. So I would be very tentatively bullish gasoline. I think VLSFO, which is kind of a proxy for diesel as well, I would be bearish kind of that market versus Brent right now. Certainly wouldn't want to be long that. And I think tentatively bullish on gasoline. I agree. There's still some bullish upside sentiments come in. And we talked about refinery fires and all that. So it's hard to be short at the moment, but I would just be a little less high conviction on that. I think crude is still where the conviction should be because nothing's going to get in the way of the rally and the refiners buying crude because the product prices are there. As long as those exist, the price could be 150. As long as that differential between the product prices and crude is strong, they'll keep buying. So yeah. Okay, so now it's time to cross to our publishing arm, the officials. Hello, Ed. You're alone.
Hello, can you hear me? Hi. So I think it really refers back to what you were talking about earlier about the physical strength, because despite some kind of last week in the North Sea window, for instance, it was a bit of a tricky one to read because Monday we had Gunvor come in and buy 3 Midland cargoes in really quick succession right at the beginning of the window, and then
this is the
the
US
rest of the
crude
week
that settles the North Sea benchmark.
Yeah,
There was some buying in that.
And then the rest of the week was pretty quiet. I think leading into the Easter weekend, there was quite a large kind of brisk off sentiment. People wanted to take it a bit easy after the tariff chaos. And then yesterday, we come back after Easter, and we get this same move by Traffic coming by 3 Midland cargoes. So that's the VLCC worth of crude. And throughout that time, we have this very strong physical diff. So on my screen now, we can see the North Sea data Brent physical differential. And it's been pretty strong since early March. There was this bull play in IE week when it jumped up towards 80, 90 cents, came off a bit towards mid-March, but then since then it's been building back up to over $1, and it's been pretty sticky. So despite that relative quiet window last week, except from Monday's session. So really, like you're saying, with the Brent front spread, the physical diff, and DFL also, the May DFL being pretty strong. So that's dated to frontline Brent swap. So that's risen pretty consistently last week and a half or so. So this physical strength is still very much forefront of our mind when we're looking at the spot window in the North Sea. And it's a similar story in Dubai, really. We've got the physical premium in Dubai has been a bit choppy in coming into April, but since about the 5th of April, it's been building up steadily. Although the last couple of sessions it's started to dip, but there's still a lot of buying. So today we got another 3 convergences. So that's another 1.5 million barrels of crude. And as you said, if you get in the spot market, people coming in buying a VLCC worth or a few Aframaxes, suddenly that makes the physical demand that picks up very quickly, like you were saying earlier in the show.
Great. Thank you, Ed. Okay, so we will leave it there. Thanks, guys. Thanks, Harinder. Thanks, Harry. And again, just a quick reminder, please like and subscribe. We're getting a lot of interest in this podcast. Really hope you're enjoying it. Please, all the feedback in the world, we would love to hear it. And also, everything we're talking about can be traded on Onyx Markets. Please go and check that out and have a demo account, have a play around, go and talk to our team. And also Flux is our platform for all the news you could need, all the data you could need, and actually trading if you're in the industry, trading on the exchange. So please check that out too. See you again next week. Thanks again.